Q3 of this year, venture cap funding for crypto startups, believe it or not, hit a new low in 2022 at roughly $5.5 billion in fundraising. Now, this is according to Galaxy Digital. Joining us to discuss all of this is investment banking firm Dragonfly Capital's partner, Tom Schmidt. Tom, it's great to have you.
Thanks for having me on.
Yeah, I'm going to drive straight right into it. Dragonfly's portfolio, it does include companies in the DeFi and NFT space. Do you expect investments to drop further amid the FTX fallout?
Well, right now, we're really sticking to kind of what we know best, which is backing teams at the earliest stages and leaning on our technical backgrounds to diligence teams and understand what they're working on. I think we're looking for later stage opportunities, but we're not seeing as many of them on the market as we'd like to see. A lot of teams raised a lot of money in the past year and aren't necessarily going to the market right now. But I think we'll see over the next year or so if some of those teams start to run low on runway or are looking to bring on more strategic partners, that the market's going to shake out. But certainly, I think a lot of teams just won't make it through this bear market as some of the funding dries up.
Tom, you brought up some bit about these new companies that are, in terms of their management, et cetera, and due diligence. Has anything changed? FTX particularly, what we know now is that there was no board of directors, there was no CFO, there didn't seem to be any kind of normal corporate governance. How much of a focus has corporate governance become for you guys, if at all? And if so, have you gone back to some of your investments and say, look, guys, get a board? Do you have any investments that don't have that?
I think it's a trend that's been happening in Silicon Valley over the past decade, not even inside of crypto, is basically giving founders a outsized portion of control. And that's sort of what we've seen from these founder CEO companies that have done so well in the market. I think for FTX, certainly oversight was an issue there, but I think a larger issue here was just around financial diligence and understanding the relationship between FTX and Alameda, understanding the relationship between FTX and these other entities. So I do think the tide is shifting a little bit in favor of VCs such as myself and their ability to hold leverage in negotiations, which might include asking for board seats or asking for more control over corporate governance, but so far we have not seen a massive shift there.
And have you gone back to any of your previous investments and asked them to change some of their behavior or change any of their governance, or do you put that in place prior?
Not yet. It's something that we'd be revisiting, but yes, generally it happens when a deal is being negotiated.
So, a lot of times we hear whenever these companies, and there's always a young analyst that puts together a sheet on what they know about the company, and it was inevitably will put good management. And of course, a lot of the companies you're investing in, some of these kids might not have any management experience at all. How do you take care of that investment in such a way in which they can grow and these people can learn about management, or do you try to put in people who have had experience in managing to manage the growth? Because a lot of times these are entrepreneurs might not have had any experience whatsoever in dealing with large organizations.
It's something that we try to weed out as we're actually diligencing the investment is this a founder who can grow into a management role and be able to grow with the company as it scales? The type of skills that you need as a seed stage founder are very different than what you need at a Series C and beyond. And we try to find teams that can go that distance. One thing to also keep in mind is, only about 50% of our portfolio are some of these more traditional equity-based deals like a exchange and the like. Another chunk of our portfolio are new layer ones or DeFi protocols where the goal is to get control over the protocol into the hands of the community earlier on. And so the role of the founder might be less important other than their initial role in building sort of a founding team and getting this thing to market and getting traction on it.
All right. We're just going to bring up this tweet of Binance CEO and founder CZ. He's he's chosen an industry to mention that they are going to actually be hiring and hiring more than 2,000 or so employees. And this is coming at a time when crypto companies, as we know, like Coinbase, Gemini, and OpenSea have seen job layoffs recently. What is your outlook on the industry and employment in general, given this diabolical standing off of what CZ is saying and what's happening with some of the other companies?
Yeah, I mean, hiring is in large part a byproduct of funding. And I think that's everything's sort of downstream from there. We have some portfolio companies which are printing money and are looking to ramp up, similar to Binance. Others which have tightened the belt and looking to extend their runway if we see a prolonged bear market. But I think all of them are seeing more talent coming onto the market now than ever before. People from Web2 companies who have been laid off or just curious about crypto, choosing to take the plunge now, or people who are leaving larger companies in the space, like a Coinbase, like a Gemini, like an OpenSea, and looking for something smaller. So I think that is really sort of the bellwether of the industry and its health is there great talent flowing into the space? And so far, that seems to be true.
Yeah, I was talking to somebody in India, and he was an industry leader. Very quickly, you had to think of yourself, as Michael Jackson put it, the man in the mirror, and represent the entire industry. When I say the industry, I mean venture capitalists. What happened? Why is it that the red flags have been missed consistently? What is the most self-critical you can be to yourself?
Yeah, I don't want to let everyone off the hook here, but I do think to an extent, a lot of the FTX rounds were a byproduct of the funding environment from last year, which were extremely low interest rates, tons of capital flooding into the VC market, a lot of crossover funds dipping their toes into venture. And naturally, when you have so many more bidders than opportunities, that moves price up, that shortens diligence time, that shortens the amount of negotiation and leverage that VCs have in those conversations. And so, it's easy to look back and say, oh, there should have been a board. There should have been more oversight. But the VCs who were asking for those weren't getting into the round. And that's sort of where the rounds ended up getting cleared. I think there's certainly a lot of fishiness around the wall between FTX and Alameda, and again, the overall corporate structure. But it's not obvious to me that, in the last funding round, there were already shenanigans being played with consumer funds, or that Alameda was already insolvent, or a lot of the financial issues that we're now sort of uncovering. So at the time of diligence, things may have looked fine, but it's these broader issues, as you sort of been pointing out, around oversight, around compliance, around auditing, all those kinds of things.